As recently as a month and a half ago, early January, Wall Street and the pundits were expecting the Fed to cut rates by a quarter point 7 times. People who saw my speeches never thought that. I've made other errors, but not that one. And I thought the Fed would lower rates 3 times. And that's now what the market expects.
Hey guys, welcome back. I'm your host, Matt Fagioli, and today I'm with my favorite economist, which I don't know if you have a favorite economist, but if you were going to have a favorite economist, it would most definitely be Elliot Eisenberg. How you doing, man?
I'm great. Thanks for that warm introduction. My gosh.
Well, you know that I love you, and I love telling the story of the first time that I saw you speak. It was on day 4 or 5 of a very long week of conference at 8 o'clock in the morning. And I kind of barely made it into the room with a cup of coffee. The fact that I was in the room was mind boggling. And I thought, I definitely don't care about what's happening on the stage right now. And you are just so captivating on a subject matter that is generally not captivating. And so guys, that's my way of introducing Elliot. So Elliot, will you please just tell everybody who you are, what you do?
Sure. Well, my name is Elliot Eisenberg, as you mentioned before. I've been in the world of economics since I was about 10 years old. I got my master's and Ph.D. in public administration from Syracuse in the late 90s. So I've been doing this now for almost 30 years. And I worked for about 10 or 12 of those years as the senior economist at the National Association of Home Builders. So I've been thinking about housing for a very long time, and I love it, and I'm passionate about it. I love economics. I love talking about economics, and it's just I feel I'm the luckiest guy in the world to have people like you who appreciate what I do, and I'm thankful. And I do a lot of public speaking. That's what I do.
Yes,
a lot.
Sir. Well, and you make it just fun and entertaining, as I said, and it's a subject matter that can get very dry and blah very quickly. But we in the real estate industry, as you know, care deeply about the state of the economy, the state of housing, and having the best possible understanding and data about where that's going. And so we need you, and you make it so fun. So could you share with us, kind of, I guess the starting point would be just how do you see 2024 at the high level economics beyond housing initially?
Yeah, I'm a little conflicted about 2024. It's hard to imagine 24 being a great year. Look, the Fed's raised rates. Rates are now at 5.375 on the Fed funds rate. It's the highest rate we've had since the Paul Volcker years of the early 80s. It's 40 years roughly. These rates slowly take the oomph out of the economy. So we're looking forward to the Fed lowering rates if all goes well in the second half of the year, and that should begin to help the economy grow a little faster. That said, the U.S., America, has done remarkably well. 2023 was a stellar year. We had GDP growth of roughly 2% first quarter, 2 in the second, 5 in the third, and 2 or 3 in the fourth. A really strong year. Europe's not doing well. Canada's not doing great. Japan's not doing so well. But the U.S. had a great year. Budget deficit got pretty large, not so great, but it certainly helped the economy grow. Unemployment is low. Labor productivity is improving. Things are pretty good. There's a chance we avoid a recession here. I thought for sure we'd have a recession. Now I'm thinking, yeah, it's a 50-50 proposition. So the probabilities have gone down. Maybe we get a little bit lucky. That would mean interest rates fall more slowly and maybe less than if we have a recession. But that's a good thing, all else equal, right? So I'm thinking for housing, depending on where you are in the housing world, if you're on the existing side, looking to sell existing housing, you're a loan officer helping finance existing home sales, maybe we get a 5% bump up in sales activity. So it ends up being roughly a 4 million unit year, similar to 23, a little better, maybe 4.1, 4.2. But again, it's hard to be great because house prices are high, rates are high, and inventory remains very low. And the lock-in problem is very serious. People refinance their house. They got a 3-year, 12 million, 3%, 3 million year loan, and no one's moving. That's the problem there. But the advantage, the opportunity that presents because no one's selling their house because they have 3 and 3.5% mortgages is new home construction is pretty good. Mm-hmm. This is very odd. Rates are very high. Normally, when the Fed raises rates, they expect interest-sensitive sectors of the economy to weaken. And that would be primarily, in the very short run, automobiles, and housing. And automakers are selling a reasonable number of cars because supply chains cracked and broke, 2 years ago. And as a result, you couldn't get a car. So now the cars are available, people are buying cars. Maybe now the high rates are beginning to have an impact and car sales are declining a bit, but they're remarkably strong given how long rates have been as high as they've been. And new home construction is holding up really, really well because there's no existing inventory. And that's giving our economy more propellant, if you will, to keep our economy going, avoid the recession, have pretty decent GDP growth as a result. So I suspect existing home sales up a little and new home construction also up a little. So this is all else equal. Given high rates, this is a pretty good story for housing. And the economy as a whole, if we get 1.5% GDP growth in 2024, I'd be a happy camper. If we get a little bit less, it's probably because we have a very mild recession.
Well, going back to the macro level for just a minute, what do you think what's your assessment of what's driving that growth in the U.S. versus other countries? And I guess I want you to speak to it, especially from kind of a Main Street USA mindset, because, I think a lot of people look at that and go maybe I don't feel that at the Main Street level. So what's driving that?
So there are a couple of things. One, as I alluded to earlier, the budget deficit in 2023 grew quite a lot. So that was you add a couple $100 billion of deficit spending to the economy. That's a meaningful amount of money. It bumps GDP up 1-2 percentage points. That matters with multipliers and so on. So that's a big part of the story. It really is. The other big part of the story is Americans have been very willing to spend down the excess COVID savings that we generated during the worst of COVID. During 20, when we got 2 stimmy checks, we got one in April of 2020 and then one in December of 2020. And then we got another one in April of 21. And people also saved more than just that. They didn't have to pay their rent for a while, their student loans for years, and so on and so forth. We had nowhere to travel. So if you made good money in 20 and 21, for example, as a realtor, a loan officer, or whatever, you couldn't spend it. So we created this huge pile of money that, depending on how you measure it, is somewhere about $2.2 trillion. And we've been spending it all down. And by mid this year, it'll all be gone. So the combination of fiscal policy that's stimulative in the budget deficit sphere and our willingness to run down our savings. We reduced our savings rates, we've increased use of credit cards, and we've run down our COVID money. And that together has propelled the economy very strongly. Now, these things are all coming to an end here one way or another. Savings rates can't get much lower. We're out of COVID savings. Now we need to have the economy create lots of jobs and hopefully high wages. But that's the story. And it's a not uniquely, but largely an American story. You don't see it in Europe. Their willingness to spend their COVID savings is much reduced compared to ours. They've got more of it. They didn't get as much, and they're less willing to spend it. Both.
And they also, I assume, European countries, China, whatever, haven't injected that, hundreds of billions into the budget at the national level as well.
Correct. They've been fiscally much more conservative than we've been, maybe more appropriately conservative, we can argue. But their budget deficits are smaller, and they didn't grow nearly as much in 23. I mean, remember, 23 wasn't a bad year. We entered 23. There was fear of potentially a recession, but that would have been too early because it takes a long time to get a recession. So it's more likely in 24. But there was just tremendous fiscal stimulus that was not necessarily needed, but certainly enjoyed.
Mm-hmm. Yeah. And I think, especially all of us that are, run around the housing space, I think that there's always been this elevated tension and expectation of recession because of the way the business feels for us.
Right. And part of that's inflation itself. People really hate inflation. There's no question about it. You ask Americans, problem number one type of thing, what's bothering you? Inflation. Yeah, unemployment's low. Job growth is good. Wage growth is not bad. But that inflation just hits them in the face every time they go to Chipotle or the supermarket to buy some cornflakes or whatever it is. And they go, oh my gosh, it used to cost X and now it costs Y. And that makes me angry. And I must admit, I'm guilty of that as well. My favorite yogurt went up by 50 cents from $1.50 to $2. Like, whoa. Can I afford it? Yeah. But I'm not a happy camper as a result.
Yeah, yeah, yeah. Well, you said something a few minutes ago that I want to pull you back to about it coming to an end, the savings and things like that. And you said something about the middle of the year. So is that the stuff that you think leaves the recession looming? Is that we're going to hit this wall, or talk to me about that some more?
Yeah, that's a major part of it. Absolutely right. So if you think of it like this, pre-COVID, we were on a spending trajectory that looked like this. All right. Just solidly up every couple of years, $1 trillion more in disposable income. You pay taxes, that's what's left to spend. And then COVID hits, and of course it goes down, well down, but then it comes back up. And now the spending trajectory post-COVID is the same as it was pre-COVID. The line is perfectly straight with the ditch for COVID. But that presupposes that the income growth we experienced pre-COVID is the same as the income growth we experienced post-COVID. But it's not. What happened was inflation clobbered us between early 21 and mid 22, when inflation really took off and year over year inflation peaked at about 9.1%. So incomes essentially declined by 7 or 8% because of that problem, that rapid inflation that was unexpected. Workers didn't get 10 or 11% pay hikes. They got 2 or 3% pay hikes like they got the year before, but inflation was 9 and real incomes fell by 6 or 7. And suddenly our incomes aren't so high. And we've compensated for that with reduced savings, more credit card use, running down excess COVID money. Right now, we've got to get that income level back on that earlier trajectory at some level. And the way to do it would be to have good job growth and good wage growth that doesn't cause inflation. That's the key. And the only way you can get that is with increased labor productivity. And fortunately, we have that in spades of late. We've had terrific labor productivity growth the last couple of quarters. Whether it continues or not, I don't know. But if we do, and we continue to have increases in the labor force participation rate, which would push down wage growth as well, we would have good job growth, hopefully decent productivity growth, and we could get back to that trajectory and keep it going. But there are a bunch of ifs, as you heard in that statement. So it's a little dicey.
Talk to us a little bit about how productivity is measured, because that seems like when you hear that kind of statistic, you're like, how do you tell me what that actually looks like?
Okay, that's a question. I'm not even sure I can answer the question because it's complicated. In the old days, it was easy when you were making pizzas. It was effortless. You make 10 pizzas, now you make 11 pizzas. Wow, productivity's bumped up 10%. Doing services is a little more complicated. String quartet productivity is harder to measure or whatever it is. That said, you look at hours worked, you look at output, and so on and so forth. And I have been skeptical of these increases in labor productivity that the Bureau of Labor Statistics has been telling us is happening, because of late, the last year or so, the vast majority of jobs that we've created have been in K through 12 education, leisure and hospitality, and healthcare, sectors that aren't really prone to labor productivity growth. I mean, schooling, K through 12 is what? What's that? That's a sage on stage, if you will, right? Teacher in front of the 25 kids. Healthcare, yeah, they're trying to automate record keeping, but it's still a very labor intensive business. And leisure and hospitality, hotels, you want a massage, it's still a person, giving you a massage. That said, what seems to be going on is because unemployment is low and wage growth has been relatively rapid of late, firms are figuring out how to do things better using more automation, mechanization, maybe starting to use AI, although that's a little early to see labor productivity growth from that. But it's just a general improvement in productivity because of some baseline costs that have gone up enough to make firms realize we got to do something. If this continues, it would be golden, because think of it this way. If wage growth is, say, 3% and labor productivity is 1%, 3 minus 1 gets you 2% inflation. This is a really important understanding. Wage growth minus labor productivity gets you inflation. But wage growth now is running too high, which is kind of good because we want to get wages back on that old trajectory that we had pre-COVID that kind of fell because of inflation. If it stays at 4 labor productivity, wage growth, but productivity goes from 1 to 2, 4 minus 2 is still 2, and you can get 2% inflation. So cross your fingers. Higher labor productivity not only increases GDP, it increases living standards. And that's the kicker. That's really important. We all live a better lifestyle. Our kids will live a better lifestyle than us if labor productivity goes up.
Mm. Man, really insightful. Thank you so much for clarifying all that.
My pleasure.
Before I dive a little bit deeper into the housing market stuff, I want to ask you, I've heard lots of speculation that, well, these statistics, big high level statistics, GDP and inflation and all these things are being, manipulated. Like people are changing things that are changing those numbers, blah, blah, blah. Do you see any of that mumbo jumbo or what's going on there?
So the answer is no. The data is good. The government, the BLS, Bureau of Labor Statistics, Bureau of Economic Analysis, Census Bureau, whatever, they're putting out the best data they can. There are, however, some serious problems that bedevil the data. So a lot of these are surveys. There's survey data here. Some of it's you get from IRS data, so you get tax returns. It's very late. It takes years to get that data, but it's administrative data, so it's fine. But a lot of this is businesses answering surveys and questionnaires. And the problem is response rates have declined precipitously. So where they were 60 or 70% before COVID, now they're 30 or 40. To get them back up to 60 or 70, you have to keep asking and asking and asking the same company over and over and over again to get the response rates high. And then you have better quality data. But because they're so low, when they announce a number like the most important number of late now is the unemployment number, which comes out the first Friday of the month, that's preceded by a Thursday. Kind of like voting is the first Tuesday preceded by a Monday. This is the first Friday preceded by a Thursday. And they'll put out a number saying, employment growth in January was 140,000 or whatever it was. I think it was 335 last month, a really big number. The problem is it gets revised a lot because the standard errors are very large because the sample size is too small, essentially. So they get revised and they get revised again. So they get each revised twice. And then a year later, they get re-benchmarked. And these revisions and changes are very large. We shouldn't really look at that new monthly number like we're going to get soon for February. We're going to get it in early March. And we should know that that number is likely to be not science fiction, but of much lower quality than it was pre-COVID. Because people look at their cell phone, it says scam likely, you don't answer. Not in your phone book, you don't answer the number and then you don't call them back, whatever. So the data quality is deteriorated. So the revisions are bigger. So it's a real problem, but there's nothing we can do about it. So yes, okay. No, there's no fiddling with the data, but it's worse.
Yeah. So, but the number, if we hear a number now that's like the inflation number now versus a year ago, 2 years ago, the calculation's the same. There's nothing weird about that.
Correct. And those numbers get revised, but they get revised less because in many cases, there's problems too, but it's different. Someone's actually going to the store looking at a can of soup and saying, what does it cost to get a can of tomato soup or a pound of chicken or something? So there you've got objective information. Some of the inflation data is subjective. They asked homeowners, what would your house rent for example? If they get a little giddy and they all bump up the estimate, that would drive inflation up. So there are problems there with numbers that are estimated or asked, but that's less prone to revisions than the labor numbers. The labor numbers are really crummy in terms of response rates. Well, and that's the most important number now because Powell is obsessed about inflation. So we're depending on weak data to guide the Fed, if you will. It's not the best situation that we could have.
So let's turn our attention to housing a little bit. So you said maybe 4.1 million transactions, something like that in 24.
Maybe 4.2. Yeah, something like that. Yeah.
Well, I heard a couple of industry pundits put it up close to 5. Is that just like no way in your view? You got the the Zoom effect there.
Let's hope.
Do you think it's possible?
So, yes, if interest rates fall earlier in the year and they fall more than we think, the answer would be closer to 5. So as recently as a month and a half ago, early January, Wall Street and the pundits were expecting the Fed to cut rates by a quarter point 7 times. People who saw my speeches never thought that. I've made other errors, but not that one. And I thought the Fed would lower rates 3 times. And that's now what the market expects. So if you talk to those pundits in early January, when they thought rates were going to fall by 1.75 percentage points on the Fed funds rate. So from roughly 5 3/8 to roughly 4. Then the expectation was we might actually get a really good year.
Mm-hmm.
But if rates don't begin to fall until, say, July, not March, so we're 4 months later, and they only fall half as much, it's pretty hard to see a scenario where existing home sales bump by 25% from 4 to 5 million. That's just that's a really hard road to find.
Yeah, yeah. Okay.
So plausibility higher 6 weeks ago, 8 weeks ago, but now I don't think so.
Okay. Well, tell me about, you mentioned something earlier, and I've heard this a lot about new construction driving the market. Tell me about that.
Yeah, this is a really surprising point. So our economy's done much better than we thought. In 23, we had a good year. Partly it was the government stimulating with budget deficit, excess COVID savings, and so on. But it's also home construction activity. Home construction activity you asked an economist, gee, if interest rates go up by 400 basis points, 4 full percentage points, or 5 percentage points, through from early 22 through late 23, what's going to happen to housing starts? Well, they'd all say, well, they're going to collapse. They're going to fall off like an anvil off a cliff. But it didn't happen because the existing home stock is it's cryogenic. And as a result, builders say, wow, there's no inventory of existing homes to sell. Let's build a couple extra houses. So the rates go up. That reduces existing sales because lock-in's really strong. If you have a 3% mortgage and now the mortgage rate's 7%, forget it. No one's going to move. And then builders come in and they get a 2-1 buy down or even a 3-2-1 buy down to be competitive. But new home starts they're okay. They really are. New home sales are okay. They're back where they were pre-COVID, which had been the best. It took them 10 years to get there from the housing bust. So those are surprisingly strong numbers. They aren't like great numbers by historical standards, but by comparatively, given where rates are, they're really good. And that's helping boost GDP along with automakers activity.
What about material costs for construction and all that? I don't know how much you can, speak to that kind of detail, but I'm curious what you see on that from your vantage point.
It's not great. So prices of inputs to construction, this is not for res construction, but overall construction, peaked out at an increase of about 43 or 44% from pre-COVID numbers. So from, February 20 or Jan 20 through end of 23 or so, it was about 40%. They've come down a little bit. I think that process is largely over. And I suspect going forward, prices go back to their normal 3-4% increase a year. So I think the relief that we've got is over, but it's not going to be a big deal in and of itself.
But the relief never really came back that far. Talk to that a little bit more specifically.
Absolutely. We're never going to get back to where we were. Again, think of an example like cornflakes. The price was, I'm making it up, I don't need cornflakes, $4 for a box. It goes to $5. It falls to $4.90.
Yeah.
And we go, yeah, they don't. Actually, they haven't. Those prices, packaged goods haven't come down, but there's a little decline. Now, if it's a pure commodity like corn, wheat, soybeans, that kind of stuff, right? Oil, natural gas, there you can have wild fluctuations. And you can return to where it was pre-COVID or even lower. Like right now, natural gas prices are staggeringly low. The thing is, with a can of soup or some cornflakes, the actual cost of the corn in the cornflakes is next to nothing compared to the cost of advertising, packaging, transportation, labor, and so on. So relief at the cost of the corn is not going to really make much of a difference to the cost of the cereal.
No, cornflakes isn't going to change our life. Let's talk about oil and fuel. Price at the pump actually looked pretty attractive. I just filled up my big diesel truck at what felt like a pretty low number. So what's going on in that arena?
A lot of good luck, essentially. There was bad luck for a while, and now there's good luck. But to keep it relatively simple, the price of gasoline has been, I'm going to say, largely flat for the last 2.5 years. Now, there was one big exception when the Russians invaded Ukraine. Prices went crazy, and they've come back down. And this is because of a couple different factors. One, sure, the Russians are producing a little bit less oil. They want to get prices higher, as do the Saudis for budgetary purposes. So that in and of itself, and OPEC plus, it's OPEC, the old OPEC plus Russia, Kazakhstan, Uzbekistan, the former Soviet republics, have tried to put a damper on production levels. But other mitigating factors have helped. One, the U.S. is now producing a tremendous amount of oil. The fracking revolution primarily in Texas, the Permian Basin, and to some extent also in the Bakken Shale in North Dakota, producing a tremendous amount of oil. The U.S. is the world's number one producer of oil. The U.S. is also the world's number one producer of natural gas. On top of that, Canada's increased production, Brazil's increased production, and Guyana, which heretofore never produced any oil, is now producing hundreds of thousands of barrels a day. So there's increased supply, reasonably flat demand, if you will. And then the other key thing is China. And China's economy is growing much more slowly than we thought. When they ended their tight COVID lockdown in the end of 22, December of 22, the expectation was that they were going to come out of the gates like a rocket, like wow, right? Like a drag car. And it didn't turn out that way. They've had a number of economic problems that are out there. Housing prices are coming down. Exports are weak because there's been retaliatory efforts to reduce trade with the Chinese and Western Europe and the U.S. and so on. So their economy is sputtering. It's still growing pleasantly at 4.5%. Don't get me wrong here, but it's not growing nearly as fast as they hoped. So essentially, supply is up and demand is down, and we as consumers are big beneficiaries.
Wow, really, really cool. I'm glad you now. So
yeah,
to clarify, because I think I heard you say that we're still the number one producer of oil in the U.S. And so if as a measure of our oil independence, to use that phrase, where are we today and versus where we were, last year, the year before, whatever?
Let me give you a couple. It's a little complicated, so bear with me. So, 8, 9, 10 years ago, before the fracking revolution, the U.S. was producing 5 or 6 million barrels a day. I don't remember exactly. I think it was 5, but you get the idea. Now we're producing 13. Way up.
Wow.
And we're also the world's largest producer of natural gas. If you include natural gas and oil together, we are energy essentially independent.
Wow.
Our imports of energy and our exports of energy are roughly, but we still import oil. We need more oil than we have, but we export lots of natural gas because we don't need all that we have. So it's a little complicated, but it's a great story. I mean, this really is. We can argue, global warming and all kinds of problems. Yeah, I'm empathetic to all those things. But it's better to be energy independent than not, all else equal, right? It gives our politicians are able to do things and exert control and push for things without fear of massively high oil prices driving us into recession. So this is a very interesting and unexpected development. And the similar technology that's resulted in our increase in oil production has also helped increase our natural gas production. Not long ago, the belief was the U.S. was going to have vast shortages of natural gas, and we were going to have to import lots of natural gas and import it from Qatar, for example, one of the largest producers, of Australia. And you have to freeze it down to minus 400 degrees Fahrenheit, roughly, or whatever it is, and turn it into a liquid, transport it across the ocean, and then regasify it at this end. So we were going to build all these gasification plants to turn the liquid natural gas, LNG, into natural gas and run it through pipelines. And now we're doing the opposite. We're freezing it at our end and transporting it as cold natural gas to Europe. So the economics of this has changed dramatically, and natural gas prices now are so low. They're so low. It's actually discouraging exploration because they're not making any money on the supply of the natural gas. They have to freeze it and ship it to Europe to make any money. Here domestically, they can't.
And I think that conversation, to your point, but I think to punctuate it, I think that whole conversation has changed in just the last 24 months or something, right? Like really fast.
Oh yeah, it has. It's been going on for a long time, but it's gotten supercharged of late. Yes, we're now producing. We had records pre-COVID, but now we're exceeding those records, and natural gas keeps going up.
Yeah. Cool. All right. Well, so kind of wrap up and talking about housing. You've told us your prediction about volume. What's your outlook for the next quarter, and what do you think are the factors that we really need to look for that are going to drive the outcome, other than the obvious of interest rates? But what else can we look at in terms of navigating the tea leaves here?
The key thing is that gap between the current interest rates that the homeowners have and the rate that they have to pay when they decide to sell their house and buy a new house. As that gap shrinks, that will help. And as that gap shrinks, other benefits will also accrue because the gap currently between the 10-year treasury and the 30-year mortgage is particularly large. And that's high in part because there's a fear of refi. If you're the investor getting a 7% return on a 30-year mortgage that you're taking, you know full well that owner of that mortgage is going to try, the borrower of that mortgage, you're the owner, but the borrower is going to try and refi down to 6. So you're going to want a little extra money to compensate you for the possibility or likelihood or near certainty of refi problems down the road. So as rates come down, that gap will shrink and the rate will come down, and that will be very beneficial for movement within the existing housing market. The other thing to keep in mind that's pretty good news here is home prices continue to rise. And this is a bit of a surprise. But there's not a lot of homes to buy. There's not a lot of demand for housing out there at these high rates, but there's even less supply. And as a result of that, prices continue to rise. They're not rising wildly, but if they go up 3, 4, 5% next year, this 24, that wouldn't surprise me in the slightest.
Yeah, and if you could see, which obviously you can see your way south of 5% on rates, and you have this 2-1 buy down or even a 3-2-1 buy down on new construction or resale. I mean, you can get to a reasonable place of interest rate to make that jump away from your current 3% or whatever.
Sure, absolutely. And the other thing to keep in mind about the overall housing market, and this is important, is 4 million really is the bottom level. That's base. There's just demand for housing that occurs because people get married, a spouse dies, you have to move because of your job, you've recently had octuplets, whatever it is. There's just baseline demand. So we rarely, if ever, get below 4 million. In the last couple of months, we were below 4 million on a monthly basis. But it's a very short-term thing. We have experienced a massive decline in existing housing sales. I mean, 2021 was about 6 million, 2022 was 5 million, 2023, which just ended, was 4 million. We're not going to get below that. It's almost impossible to do it, given the size of the country and the amount of people that are forced to move for one reason or another.
Yeah, so if you, gosh, that's really positive too. So you get 4 million and go, well, that's a low number, especially from the perspective of somebody who wants to make their income from those transaction volume.
It won't get worse.
But to think, okay, cool, if whatever this is baseline, we're going up, then rock and roll. That's awesome. So
that's right, absolutely. So we've been through the worst, and that's the other important thing to keep in mind. Housing sales have gone from 6 to 4 million, a decline of 33%. I mean, that's immense. So that the existing housing market really is in a recession right now, or has been in a recession for a while already at this point. So whether the national economy has a recession or not, sure, has some implications, obviously, but not much for the housing market. Home equity is strong, demographics are very favorable, and so on. So if there's a recession, interest rates fall faster, that probably spurs on more sales activity because we're not going to have massive unemployment increases like we had back in 07, 08, 09, when unemployment doubled from roughly 5 to 10%. Now it'll go from 3.5 to 5. I mean, it's going to go up, but there's tons of home equity out there. People who can't pay their mortgage now can always sell their house and pocket some nice change.
Yeah.
So don't worry from the real estate perspective if there's a recession or not in 24. It doesn't really matter much. And the homeowners aren't going to suffer wildly either because they've got home equity. And the number of 32-year-olds, 33-year-olds right now is at a record high. Whereas 14 years ago, we were in a dip because of demographic echo booming and so on and so forth, echo busting and so on. So this is a very different world. The recession is not going to have nearly the impact it did. And it'll be favorable to housing most likely.
Cool. Well, Elliot, this is all very positive and uplifting, and I thank you so much for the update. And I know that everybody listening in here is going to appreciate it as well. So thank you so much.
My pleasure.
I love I'm still always reading your newsletter. And how does everybody find you and sign up for your amazing updates?
Wow, thank you for that nice plug, Matt. You're a gentleman and a scholar, as my mother would say. So I put out every day 70 words on economics. No graphs, no ads, no charts, no links, no photos. It's email. And the way to sign up most easily is to take your phone and text. Yes, you're texting to get an email. I understand. You're texting the word bow tie because normally I wear a bow tie when I speak. Text the word bow tie, one word, BOWTIE, no hyphen, no space, to the 5-digit number 66866. And you'll be prompted for an email address. Bow tie to 66866. You'll be prompted for an email address. You'll put it in. You'll hear from me every day. And hopefully you'll like it.
They will like it. Guys, if you're listening to this, this is a newsletter you want to sign up for because it'll make you sound smarter. If you're in the real estate industry and you're talking to clients about economics, Elliot is going to make you sound smarter, and it's easy, 70 words a day. So definitely do it. So we'll put the text information in the notes for the show. And
thank you.
We hope you'll come back and see us here soon, Elliot.
I look forward to a repeat invitation. Thank you very much, Matt. I look forward to it.
Awesome, guys. We'll see you back here real soon.